Good morning, good afternoon, good evening, folks. It is Thursday, and we haven't talked to this guy all year. What the heck? It's Mr. Jonathan Twombly. How you doing, sir?
I'm doing great, Michael. How are you?
I'm doing well. Of course, it's only the 6th, but I just thought that was funny. My sense of humor early in the morning. So, hey, Jonathan, I don't know if you saw this, but the Fed meeting minutes came out yesterday afternoon, and the market did not like them, right? The Fed we have said, I think for a month now, maybe even 6 weeks, we've actually said the Fed's not your friend, and people didn't believe us. They didn't know what that meant. Yesterday, it's now official. The Fed basically said, we're going to raise rates faster. We are going to be more aggressive, and we're going to not only taper, but we may become a seller of bonds.
Wow.
Right. So that caught the market flat-footed. The NASDAQ suffered, crypto suffered. Basically, anything that was risk on got taken off, and it was kind of a bloody day. So any thoughts on that? Kind of what we expected, I think. But
well, yeah. And I think, well, this is just my bias, but I don't think that the Fed really cares about 5% consumer inflation. I think because, frankly, they don't care about you and me. They care about Wall Street, right? So they don't care. They're not looking to cool off 5% on inflation. And we're going to talk in a minute about another topic about why 5% on inflation, 5% inflation is something that you should not be worried about, because the alternative is far, far worse than that.
Right.
But the Fed is concerned about asset bubbles everywhere.
Yeah.
And a giant asset bubble, giant asset bubble. We've just had the same asset bubble just repeating itself in different asset classes for the last 20 years. If you were basically younger than you and I, we're around the same age, you have not known life that didn't involve a bubble
somewhere,
a bubble bursting, right? Yeah. Your whole investment and financial career has been based on bubbles, which have been based on air, which is what bubbles are based on. So, and the air comes from the Fed.
Yeah. Oh no, they are the one blowing on it for sure.
They are the one blowing the bubbles, and not just them. I mean, every central bank in the world, right? Sure. So they're all doing this in coordination. So the Fed has now, they after the .com bust, they blew the housing bubble. When that burst, they blew the everything bubble, and I think they are starting to get pretty concerned about what happens if this does not if the air is not let out of the balloon in a controlled way, rather than having the whole thing go kablooey because they don't have any more ammunition, right? They're out of bullets.
No, I mean, they can't go lower. They came into the market for $100 billion. What are they going to do next time? $1 trillion a month? I mean, at some point, people lose faith.
And frankly, that would just blow. I mean, then you really just that's when the hyperinflation scenario probably takes place, right?
Oh,
if they then, double down to try to resurrect the economy, you and I have talked about this before. Recessions are painful, but they're necessary.
That is exactly right. Yes.
And the Fed has basically its mandate is like, don't let recessions ever happen again, right? And that just, I always make the analogy of forest fires, right? Like forest fires naturally occur in forests, and what happens is burns out all the underbrush, and the big trees survive, and life bounces back very quickly. But when you have humans inhabiting forested land, they don't want any forest fires because it burns up their houses, so they tend to put the fires out, which just makes the underbrush get out of control. And then when there is a fire, it's uncontrollable. It's
quick, it's dangerous, it's deadly. Yeah.
And the same thing with the economy. If you don't let those business cycle recessions happen, let companies that shouldn't be afloat, let them go, right? It's painful, but it's in the long run, it's healthy. And the Fed and the central banks around the world have decided that we can't have recessions. So what they've done instead is create we can't have a business cycle recession anymore. So what they've done is create something worse, which is blow bubbles and create financial crises.
Well, that's going to be tested. I've been actually calling for Jerome Powell to kind of get a backbone like Paul Volcker. We'll see if he can do it. Now, to be clear, because people don't know, maybe they haven't watched my channel for weeks on end, I'm not talking about rates going to 18%.
Yeah.
That's not what I'm calling for. But I am calling for potentially rates to double, which is what they did in the 70s rolling into the 80s, right? Paul Volcker essentially had rates double. So for us, that would mean going from 2.5 or 2.75 low on the 30-year fixed to 5.5. I think that's very reasonable, but that will be painful.
Yeah, it'll be painful because in a world addicted to cheap money, right? That the accelerant, basically you're taking. They've been pouring gasoline on a fire for a very long time, and then they're talking about maybe we should just pour less gasoline on the fire, and that's going to make the fire burn slower, and it's going and people who become dependent on cheap money, and all those Wall Street guys who look like geniuses who actually aren't very good at their jobs.
Yeah,
you can't pick a stock to save their life. Right? All they have to do is say buy the stock market, and it goes up.
You mean somebody who has a thesis that, hey, just trust me, tech always wins. I have a 5-year time horizon. I'm going to buy all these cheap stocks that make no money.
Yeah, or the people whose thesis is, you can't fight the Fed.
Yeah.
Right? Well, they're going to learn that you can't fight the Fed. It's just going in the direction that they want. They just want the Fed to keep on pumping cheap money into the system all the time, so things go on up forever. But the problem is, 5.5% interest rate. I mean, listen, that historically that's actually kind of cheap.
I was going to say that's in the bottom 10% historically.
Yeah. I mean, that's interest rates. When you and I were growing up, when people were buying houses, even before inflation spiked, even in the 1980s, after inflation was beaten back, you were still buying 8-9%,
8-9 all day.
Yeah, mortgages, right?
Yeah.
And
my first was 7.5 or 7 3/8, something like that.
Yeah, and so I think my first mortgage was like 6.25, right? And so that was just the way it was. So now everybody's net worth has been blown up by the Fed.
Yeah,
but it's really created. I mean, when you talk about inequality, like this is one of the main drivers of inequality. When you talk about the cost of living in places like New York and California. Housing is the reason it's expensive. Like people complain about taxes, but the real issue is the cost of housing, right? And that is, New York was always seen as expensive, but it was not seen as unaffordable, right, by most people until really the last 10 years or so, when we had the third successive bubble blown up by the Fed, right? And that just allowed people who were wealthy to just bid more, right? And just put housing out of reach of most people, right? So that's really the cause of it, and it's just something that I don't think it's acknowledged very often, that like the role of the Fed in making the denser states less affordable. Yeah, it really comes down to cheap to low interest rates, and if we had just historically average interest rates, we would not have seen what we saw.
Yeah, well, let's carry this forward, right? So again, I think you're going to see this quickly in the stock and crypto market, which has already happened. I think this is the beginning, not the end. If you want to go buy the dip and become the dip, go ahead. But let's talk about what this happens in my space, residential, your space, commercial, because we won't be unaffected. For example, residential, while I don't think we have a price crash, just given where inventory is, we will have a slowdown. I've been very, very clear that I expect mortgage brokers to be the first to suffer, just like crypto. Who are going to be the first to suffer in residential? Well, it's the people that were doing all these cash out refis and rate and term refis. Well, guess what? If rates are going up, they're not down. You're going to have a lot less refi business. And that's already happening. What was it? It came out Wednesday. I think it was 62% year-on-year refis are down. Yeah. That's not going to get better. So if you're a mortgage broker who his team got fat on refi money, you're about to lay off some people. Second, real estate agents. With rates going up, that will pull some demand off the sidelines early, right? Because they don't want to be priced out. But as rates go up longer, you're going to see a lot more people choose to upgrade their homes versus move, because, it used to be with 40 years of falling rates, you would buy your starter home, you would live on it, you would get a raise, you'd get some equity, you'd pay it down, then you would sell, you'd go to a bigger home, an extra 50 grand, but rates would be down 5 years later. So the payment shock, if there was a payment shock, wasn't great. Now, if we're on a rising rate environment for the next 2 or 3 years, the move up buyer, you're just not going anywhere. Sure, you may have some equity, but you're not going to go up 100 grand and go up a rate, a point or a point and a half. I mean, that's just that payment shock's going to be crazy. So transactions are going to fall. That's where it's going to that's going to hit residential pretty quick, but I think it's going to hit commercial as loans come up for refi or whatever that is. So it's you're not out of the woods either.
Yeah, no, I mean, I think in the commercial world, well, we've talked about this, I think the last time we spoke about the effect of rising interest rates on cap rates, right? Yeah. And I think that, as I said before, I mean, nothing has changed about my opinion. A certain amount, the market, probably the banks will absorb some of the interest rate rise in the form of compressed spreads because they want to keep the party going. But at some point, they will have to start, they won't be able to absorb it anymore. And so they'll start having to pass those rate hikes on to the purchasers. And then it becomes, well, okay, how much are the purchasers willing to squeeze their profits, right? And then, one thing that we didn't talk, so that will, at some point, the purchasers as well will just, I mean, first of all, the banks will first tell the purchasers, buyers, you can't get as much proceeds because your debt service coverage ratio calculation doesn't work. Yeah. So what's going to happen? Well, some sellers may pony up more money on the theory that, well, we're in this inflationary environment, so we got to put money into something. Except rising interest rates undermine that whole argument, right? If there's rising interest rates, then suddenly the risk-free, alternative, i.e., treasuries, become more attractive. So it's sucking money out of these assets.
Yeah, that's something I wanted to ask you specifically. Sorry to interrupt, but I wanted to ask this before I forgot. So let's just assume cap rates today are 4%. I'm just going to pick that number for, I don't know, B-class assets, whatever. If the treasury got to say 3%, I mean, where's the trade-off, right? Because at some point, the extra 1 point on a cap rate is not worth the true risk-free.
If you're talking about if the Fed rate went to 3%?
Yes, correct. Yeah.
Listen, if the Fed rate goes to 3%, the bank's spread is usually somewhere like in a range of like 125 to almost 200 basis points.
Okay. All right. Yep.
So your interest rate is going to go up to at least 4, if not higher, 4.25 or something.
Okay.
As soon as interest rates are higher than cap rates, you get what's called negative leverage.
Right.
It means that, usually you want leverage because leverage increases your returns to equity, right? But that only happens when the interest rate is lower than the cap rate. You have to have a spread between interest rate and the cap rate for that to work. If interest rates become higher than cap rates, you get negative leverage, which means for every dollar of debt that you put on to your property, your return to equity declines, right? So that will force prices down because people are in the business of making money. And since they can't usually finance like large multifamilies in cash, right? They have to get debt, right? The whole cost structure is based on debt that they will be forced to bid less because they're not in the business of making money. The only kind of things that might be countervailing forces here are, let's say if we really do have really serious inflation, something beyond 5%, then you might have people be willing to take negative leverage because it's the lesser of two evils, right?
Got it.
So, because rather than losing 10% of the value of your money every year, you'd rather lose
2% or whatever,
or whatever, right? So,
okay,
that's a better deal. The other thing is that a lot of the lending is being done by bridge lenders.
You and I have talked about that. That statement, which you brought that up, I think 9 months ago. I'm like, oh my God, this is 2006, just a different vocabulary and a different asset. I'm like, this is bad.
So bridge lenders may be willing to squeeze their spreads more than the agencies are, right? Maybe. So they may continue to want to put out money and take less of a spread just to keep going, right? And so because they have more flexibility than
I want to ask you I don't know if it's controversial, but it hit me because I know there are some hard money lenders out there that their business plan is to foreclose on a certain set and they basically get a discount on the asset.
Oh, yeah.
Are there bridge providers that are like, hey, I'm going to loan to this guy because I want the asset. Worst case, he pays me back, but best case, I get the asset for 15 points off. Is that a business model or no?
I don't know. I mean, I assume that there must be some bridge lenders who have that as
Arbitrage or whatever they want to call
as
it.
as a, you know, what do you want to call it? A not
An acceptable outcome.
Plan B that would not make them unhappy.
Yeah, that's a way to say it. Yeah, it's like it's in the business plan. Like when they look at making a loan, one of the things they must consider is like, would we want to own this, or could we get out? Because they want their money back, like all lenders do. Okay, makes sense.
Yeah, I mean they want their money back, so they don't. I don't think that they. I don't think it's like the predatory.
Yeah, no.
Out there like with the loan to the loan.
No, I didn't mean it that way. But
yeah, but I don't think that the bridge lenders are necessarily wanting to own properties, right? Because I think they just want the simple, like, we write you a check and we get checks back. Like they don't
moving their money. Okay.
They don't want the operational headache, and I think they're doing, it's a volume play for them. But I think, I'm sure that they're looking at these assets from the perspective of, well, hey, if we do have to take it over, is this something we want?
Okay.
And so that may be part of the calculation.
Okay, cool.
Yeah.
Yeah. So in the end, folks, we've been calling it for a while. That Jonathan has an entire playlist on my channel with hundreds of, I don't know, hundreds, probably 100 hours of material.
I'm sure. Yeah. At this point, yeah, it must be.
I'm sure. Yeah. It's 100 hours. It's funny. But yeah, so go ahead and take a look at that. We've been calling this stuff for a while. It's all there. And Jonathan, how can people find you?
Yeah, there's a couple of ways. If you would like to invest in deals with me, go to my website. Just Google it. That's the easiest way because the URL is complicated. But just look for Two Bridges Asset Management, and you'll find it, and just fill out the investor form, and I'll add you to my list. And the other way is if you want to kind of continue the conversation, go and join my free Facebook community, which is called the Multifamily Investment Community on Facebook. And then there actually is one other way. We don't talk about it very much, but you can join my coaching program as well. If you go to multifamilylaunchpad.org/join, you can check out the program. It's very affordable. We have great calls every month. Actually, our monthly call was last month. It was really fantastic. So please feel free to join that. You get 60-hour course, you get underwriting models, you get checklists, you get just a whole suite of materials to jumpstart your multifamily investing career. So check it out.
Very cool. Thanks, Jonathan.
Absolutely.